Hello there, Mr. Evans here, looking at private limited companies in this short video. So we are here, we've looked at sole traders. This video will look at private limited companies, and then in the next video I will look at how private limited companies are different from public limited companies. So just a reminder, we've looked at sole traders. AQA have removed partnerships from the specification, so we don't need to know about them anymore. There's no chance that there will be an exam question asked on partnerships, so we'll move straight on to incorporated businesses, private limited companies and public limited companies. An incorporated business is a business with a separate legal identity from its owners. Okay, we know they're incorporated because they include the word company, private limited company, public limited company. That shows that the business is a separate legal identity to its owners, and its owners benefit from limited liability. Its owners are only responsible for the money that they invest into the business in the form of share capital. So the owners may buy shares in both private and public limited companies. If something were to go wrong in these businesses, rather than their personal possessions being at risk, okay, they'd lose the money they've invested in shares, but the owners benefit from the fact that that is the only money that they will lose. Okay, that money may well be very significant, but they're not going to be losing their personal possessions as well. Looking particularly at private limited companies, a private limited company is an incorporated business that's owned by shareholders who tend to be family and friends of the entrepreneur. They benefit from limited liability. So a private limited company is a company that does not sell its shares on the stock market, hence it is private. The owners are limited to individuals who have been authorised to buy shares in that company. Okay, a public limited company will share shares to anybody on the stock market. So generally, this is only a general rule, private limited companies tend to be relatively smaller companies, although the examples there are of, obviously very big companies, but private limited companies do tend to be slightly smaller than PLCs, often run by family and friends of the entrepreneur. So the advantage is the owners benefit from limited liability. Limited companies have the potential to raise more money through selling shares, so if they need finance, we might not have to go to the bank. We could find somebody that we want to invest in our company and invite them to buy some shares, become an owner. That's another good way of getting skills into the company. Okay, if the limited company, the private limited company, is lacking somebody with really great accounting skills, we might know somebody, good accountant, invite them to buy some shares, and at the same time ask them for their input to the management of the business. There is a separate legal identity for an Ltd. Okay, so if a sole trader decides to, they might have a decent business, but for whatever reason they decide that they want to move on, that business would close down. An Ltd, even if the shareholders change, the business itself remains, the brand itself remains, which can be an advantage. Owners are invited to invest in these companies, which means we get to retain ownership, we get to retain control over ownership, and we should have a synergy of interests in the owners. In other words, we're not going to invite people to become owners of our company if they don't share our values, or we'll try not to do that anyway. The disadvantages of becoming a private limited company is that some financial records become publicly available. There are going to be greater regulatory responsibilities than for a sole trader. There are some documents that need to be put together and signed by a solicitor, and that will take time and money. A private limited company can't sell shares on the stock market, which may limit its financing opportunities to that certain group of people who are investing. And sometimes suppliers might view the limited liability as a risk. If you don't pay your suppliers and the business goes into liquidation, the owners aren't then responsible. Maybe some suppliers may consider it risky to do business with a private limited company. A couple of examples of some big private limited companies that you're probably aware of: John Lewis and Odeon cinemas. John Lewis has got a very interesting ownership structure, well worth looking at, where the employees are owners of the business. Okay, they form the owners, the shareholders. Okay, so that's private limited companies.